Why most people fail to benefit from compounding. Compounding is often called the eighth wonder of the world. It's praised by investors, economists, and personal finance gurus as the ultimate force for building wealth, skills, and success over time. In theory, it's simple, small, consistent gains accumulate, and eventually those gains begin to generate profits of their own. Over long enough periods, the results can be extraordinary. And yet, despite knowing this, most people never meaningfully benefit from compounding. They understand it intellectually but fail to experience it practically. They hear stories of investors turning modest savings into fortunes, of creators building massive audiences from humble beginnings, and of professionals whose careers seem to suddenly take off after years of quiet effort. Still, they remain stuck, financially, professionally, and personally. The reason isn't a lack of intelligence or access to information. The real causes are psychological, behavioral, and structural in nature. Compounding rewards patience, consistency, and delayed gratification, traits that modern life actively discourages. Let's explore why most people fail to benefit from compounding, even though it's available to almost everyone. Compounding is invisible at the start. The biggest enemy of compounding is how unimpressive it looks in the beginning. Early progress feels slow, almost pointless. The first few months of saving money barely move the needle. The first year of investing might produce returns that feel trivial. The first 100 blog posts, workouts, or skill-building sessions seem to go nowhere. Humans are wired to respond to immediate feedback. We're motivated by quick wins and visible results. Compounding, however, delays gratification. It hides its power until later, when momentum has already built. Most people quit before compounding has a chance to reveal itself. They stop investing because the gains don't feel worth it. They abandon learning a skill because progress feels too gradual. They quit content creation because no one is watching yet. They don't realize that the early phase isn't broken, it's required. Compounding always feels disappointing before it feels inevitable. People overestimate short-term results and underestimate long-term ones. Another reason compounding fails most people is poor time perception. People dramatically overestimate what they can achieve in a month or a year, and severely underestimate what they can achieve in a decade. This mismatch creates frustration and impatience. When expectations aren't met quickly, people assume the strategy is flawed. They jump to something new, reset progress, and start over, again and again. Every reset destroys compounding. Compounding only works when you stay in the game long enough. But staying requires accepting boredom, slowness, and uncertainty, things most people are deeply uncomfortable with. Instead of committing to one long-term path, people chase short-term optimization. They look for hacks, shortcuts, and breakthroughs. Ironically, this behavior produces the opposite effect: stagnation. Inconsistency breaks the chain. Compounding depends on consistency. Miss too many steps, and the curve collapses. Saving sporadically doesn't compound. Investing only when you feel confident doesn't compound. Working on a skill only when motivation strikes doesn't compound. Most people rely on motivation instead of systems. Motivation is emotional, unpredictable, and fragile. Systems are boring, but they work. Compounding doesn't care how inspired you feel. It rewards repetition. The people who benefit most from compounding aren't necessarily the most talented or passionate. They're the ones who show up on average days, bad days, and days when nothing seems to be working. Unfortunately, modern culture glorifies intensity over consistency. People want dramatic effort in short bursts rather than small effort sustained over time. But compounding punishes this approach. Emotional interference destroys long-term gains. Compounding requires emotional restraint, especially in investing and career decisions. Markets fluctuate, careers plateau, skills regress before they improve. These are natural parts of long-term growth, but emotionally difficult to endure. When fear or excitement takes over, people sabotage their own progress. They sell investments at the worst possible time. They abandon promising paths during temporary downturns. They chase trends just as they peak. Compounding thrives on calm behavior. It requires resisting the urge to react to short-term noise. Most people know this in theory. In practice, emotions win. The irony is that compounding amplifies behavior as much as it amplifies results. Good habits compound into extraordinary outcomes. Bad reactions compound into repeated mistakes. Lifestyle inflation eats the benefits. Even when compounding works on paper, many people never experience its benefits in real life because lifestyle inflation quietly consumes them. As income rises, spending follows. Raises, bonuses, and investment gains don't create freedom. They fund bigger homes, nicer cars, and higher monthly monthly obligations. What should have accelerated compounding instead locks people into more complexity and stress. The numbers improve. Life doesn't. Compounding requires restraint, not only in how you invest, but in how you consume. If every increase in income is matched by an increase in expenses, compounding has nothing to multiply. This is where most people go wrong. They don't fail to earn more. They fail to keep more. Without a meaningful gap between income and spending, wealth remains theoretical. There's no buffer, no flexibility, no margin for compounding to operate. Every dollar is already spoken for. This is why high earners often feel trapped, while moderate earners with disciplined habits quietly build real wealth. Compounding doesn't reward how much you make. It rewards how much room you leave. Margin, not magnitude, is what compounds. People confuse effort with progress. Another hidden reason compounding fails is the misunderstanding of leverage. Compounding works best when effort is applied to things that scale: investments, skills, systems, and assets. Many people work incredibly hard, but in ways that reset every day. Trading time for money has limits. When effort doesn't carry forward, it can't compound. Learning high leverage skills, building assets, creating systems, and investing early all allow yesterday's effort to benefit today. But these paths often feel riskier and less predictable than traditional linear work. Most people default to what feels safe and familiar, even if it caps long-term growth. Patience is socially undervalued. Modern society worships speed. Fast success stories go viral. Overnight wins dominate headlines. 10-second clips outperform 10-year journeys. Algorithms reward novelty, not endurance. The quiet, unglamorous grind rarely gets attention because it doesn't look impressive in real time. This distorts expectations. When progress doesn't show up quickly, people assume something is wrong. They feel behind. They interpret slow growth as failure rather than as evidence they're on the correct path. If results aren't visible, public, and shareable, they're dismissed as insignificant. But almost all meaningful success is invisible for a long time. Careers compound in obscurity. Wealth builds quietly. Skills develop through repetition. No one applauds. By the time success looks sudden, it's usually the result of years, sometimes decades, of patient, unnoticed effort. Compounding doesn't care about optics. It doesn't reward attention, hype, or timing. It rewards staying power. And because patience isn't celebrated or even acknowledged, most people abandon the process long before the payoff arrives. They mistake silence for stagnation and quit just before momentum takes over. Compounding is simple, not easy. Compounding fails most people because simplicity is confused with ease. The concept is straightforward. The math is basic. The formula is well known. But the behavior required to make it work is brutally difficult. Doing small, intelligent things consistently over long periods sounds easy until boredom sets in, until doubt creeps in, until progress slows, distractions multiply, and motivation fades, until results lag far behind effort. Compounding demands discipline long before it offers proof. It requires showing up when nothing exciting is happening, sticking to the plan when outcomes are uncertain, trusting the process when the reward feels distant and abstract. That's the trade-off most people refuse to make. They want evidence before commitment, momentum before patience, validation before effort. Compounding asks for the opposite and only pays those willing to endure the delay. Final thoughts. Compounding is available to almost everyone, but realized by very few. Not because it's hidden, not because it's complicated, but it requires patience in an impatient world, consistency in a distracted world, and emotional control in a reactive world. Those who benefit from compounding aren't smarter or luckier. They're simply willing to stay when others quit. If you understand that and act on it, you're already ahead of most people. If you found this valuable, like this post, subscribe for more deep dives on wealth, mindset, and long-term thinking, and comment below. Where do you think compounding could make the biggest difference in your life? It's destroy wealth. Most people think compounding is a good thing, and they're right when it works for you. But compounding is neutral. It doesn't care whether it's helping or hurting you. That's why it can be just as dangerous when it works against you. Negative compounding is the silent wealth destroyer. It's the reason small mistakes in spending, borrowing, or habits can grow into massive problems over time. The scary part? It usually starts small, almost invisible, and then accelerates before most people even notice. What is negative compounding? Positive compounding is when money, skills, or habits grow exponentially over time. Negative compounding is the opposite. It's when mistakes, debt, or destructive habits snowball, eroding wealth, health, and opportunities. Here's the key difference. Positive compounding amplifies good behavior. Negative compounding amplifies bad behavior. It's subtle, slow, and often goes unnoticed. But over the years, it has become devastating. Debt. the most obvious form of negative compounding. Debt is the textbook example of negative compounding. High-interest debt grows exponentially, just like investments, but in reverse. Let's look at an example. Imagine a credit card with 18% interest. You carry a $5,000 balance. Using the rule of 72, your debt will double in just 4 years if left unpaid. Year 0, $5,000. Year 4, $10,000. Year 8, $20,000. That's the power of compounding, but it's working against you. Even minimum payments often fail to keep up with interest. Over time, balances balloon, stress rises, and options shrink. Debt doesn't just take money, it takes time, freedom, and peace of mind. The hidden costs of debt. Most people focus on the interest rate, but negative compounding comes from more than just numbers. Missed opportunities. Every dollar spent paying interest could have been invested and grown. Psychological stress. Debt creates pressure that leads to poor decisions. Behavioral traps. High debt can trigger panic selling, impulsive borrowing, or lifestyle inflation. Even seemingly manageable debt compounds quietly, eroding wealth over the years. Lifestyle inflation. The slow poison. Negative compounding doesn't always come from debt. It also comes from lifestyle inflation. As income rises, spending tends to rise even faster. New car, bigger house, fancy vacations, expensive subscriptions. The problem isn't earning more, it's failing to save or invest the difference. Even if your investments are compounding at 7–8% per year, lifestyle inflation eats those gains. Money grows on paper, but your freedom, security, and options don't. Bad habits, compounding against you. Debt and lifestyle inflation are financial examples, but negative compounding extends to habits and personal growth. Consider these everyday examples. Skipping exercise. A small health deficit compounds into chronic disease over decades. Poor nutrition. Eating poorly now compounds into higher medical costs, lower energy, and a shorter lifespan. Time-wasting habits. Hours spent on passive activities compound into skill deficits, lost income, and stagnation. The scary part? Bad habits compound faster than good habits, because they often require less effort. The psychology behind negative compounding. Humans are wired to underestimate slow, negative growth. We notice rapid changes easily, like sudden losses or big wins. We ignore small, steady drains, like tiny monthly overspending, minor procrastination, or subtle unhealthy habits. This is why negative compounding often goes unnoticed until it's severe. A $100 monthly credit card habit doesn't feel like much. After 10 years, it has grown to $20,000 in interest alone. Small, repeated choices matter far more than one-off events. How financial negativity compounds. Let's break down a common scenario. 1. You have a credit card debt of $2,000 at 18% interest. 2. You pay only the minimum monthly amount. 3. Interest accrues faster than you can reduce the principal. 4. Over time, the balance doubles, triples, or quadruples. 5. Stress and late fees accelerate the problem. Now imagine adding lifestyle creep. New phone, new car, subscriptions, fancy dinners. Even modest income increases are absorbed by new spending. The gap for saving disappears. Your wealth trajectory goes negative. And yet each step feels normal. This is the insidious nature of negative compounding. It disguises itself as ordinary life. Avoiding negative compounding in finances. Here's the good news. Negative compounding can be reversed, but only if you act early and consistently. 1. Pay down high-interest debt immediately. Focus on the most expensive debt first. Even small overpayments accelerate your escape. 2. Build an emergency fund. Avoid new high-interest debt by having cash ready. 3. Live below your means. Avoid lifestyle inflation no matter how much you earn. 4. Automate savings and investments. Let positive compounding work for you while you sleep. 5. Track your money. Awareness prevents small leaks from becoming financial avalanches, avoiding negative compounding in life. debt isn't the only area at risk. Negative compounding happens in health, habits, and mindset too. Health. Skipping daily exercise compounds into chronic disease, lower energy, and higher medical costs. Early interventions, like walking, stretching, and proper nutrition, prevent decades of compounded harm. Skills and knowledge. Failing to invest time in learning compounds into stagnation. Small, consistent improvements create career and life growth. Neglect compounds against you. Time management. Hours wasted on unproductive habits compound into lost opportunities, lost income, and diminished skills. Think of every decision as either positive compounding or negative compounding. Real-life examples. Example 1, credit card debt. $5,000 at 18% interest, paying the minimum. After 10 years, one's $11,000 owed. After 20 years, one's $25,000 owed. Example 2, lifestyle creep. $500 monthly raise absorbed by new spending. Instead of saving, your raise compounds into nothing. Example 3, health habits. Skipping daily exercise compounds into chronic fatigue, injury, and rising medical costs. 10 years later, the cumulative effect is severe. Notice a pattern? Small, repeated choices are more powerful than rare, dramatic ones, whether positive or negative. The role of psychology in negative compounding. Avoiding negative compounding is less about knowledge and more about behavior. Humans underestimate small, gradual losses. We overestimate short-term gains. We are wired to react to crises, not slow drains. This is why early action is so important. The earlier you eliminate debt, reduce wasteful spending, or build healthy habits, the more time positive compounding has to work. Turning the tables, make compounding work for you. Here's the upside. The same principle that destroys wealth can create wealth. Pay off high-interest debt. Your money stops shrinking. Save consistently, your money grows exponentially. Improve skills, your earning potential doubles over time. Invest in health, you extend life and productivity. Negative compounding is powerful, but so is positive compounding. The difference is simply which direction you choose to let it work. Small habits, big consequences. Here's the takeaway. Small, repeated behaviors matter more than huge, occasional actions. $50 overspent monthly compounds into thousands of lost dollars over decades. 1 extra hour of learning per day compounds into expertise, career growth, and financial advantage. Skipping a workout compounds into health decline over the years. This is the secret of compounding. Small actions, repeated consistently, either build or destroy over time. Lessons from negative compounding. 1. Start early. The earlier you address debt or bad habits, the less severe their compounding effect. 2. Be consistent. Small improvements every day accumulate faster than rare, dramatic efforts. 3. Track everything. Awareness prevents tiny negative behaviors from snowballing. 4. Focus on behaviors, not outcomes. You can't control market returns, but you can control habits and spending. 5. Use compounding in your favor. Let your money, skills, and health compound positively while minimizing negatives. Negative compounding is subtle, relentless, and often invisible. Small debts grow exponentially if ignored. Lifestyle inflation silently erodes wealth. Bad habits compound in every aspect of life. But awareness gives you the power to reverse the trajectory. Focus on early action, consistency, and restraint. Turn the silent force of compounding from an enemy into an ally. Final thoughts. Compounding doesn't care whether it's helping or hurting. Debt compounds against you. Bad habits compound against you. Neglect compounds against you. The solution is simple in theory, but challenging in practice. Act early. Act consistently. Act wisely. Do that, and you'll turn the same force that destroys wealth into the force that builds it. If this helped you understand how negative compounding works and how to protect yourself, like this video, subscribe for more insights on money, habits, and long-term wealth, and comment below. Which area of your life is compounding against you right now? Balancing compounding with market cycles, risk versus return. Compounding is often presented as an unstoppable force. Start early, stay consistent, and let time do the heavy lifting. In theory, that's true. Compounding can turn modest inputs into extraordinary outcomes. It's the engine behind long-term wealth creation, skill mastery, and durable success. But compounding does not operate in a vacuum. Markets move in cycles. Economies expand and contract. Assets rise, fall, stagnate, and sometimes collapse. Risk is not evenly distributed across time, and returns are rarely smooth. Anyone who believes compounding works as a straight straight, upward line has misunderstood both markets and human behavior. The real challenge isn't understanding compounding, it's balancing it with market cycles while managing risk in a way that allows you to stay invested long enough for compounding to matter. That balance between patience and protection, optimism and realism, risk and return is where most people fail. Compounding is long-term, markets are cyclical. Compounding assumes continuity. Markets guarantee disruption. Over long periods, markets tend to grow, but in the short and medium term, they move in cycles: bull markets, bear markets, corrections, crashes, recoveries, and periods of stagnation. These cycles are inevitable, recurring, and emotionally taxing. Compounding needs time. Market cycles test endurance. This creates a fundamental tension. To benefit from compounding, you must remain invested. To survive market cycles, you must manage risk. Lean too far in either direction, and the strategy breaks. Ignore compounding, and you overtrade, overreact, and reset progress. Ignore cycles, and you risk catastrophic drawdowns that permanently impair your ability to compound. Balancing the two requires understanding that risk and return are inseparable, and that higher returns always come with higher volatility. Risk is the price of compounding. There is no compounding without risk. Any asset capable of meaningful long-term returns will experience volatility. Equities outperform cash over decades precisely because they are risky in the short term. The discomfort is not a flaw, it's the fee. The problem is that most people misjudge risk. They think risk means losing money, when in reality risk is the variability of outcomes. Temporary losses are normal. Permanent losses are the real danger. Compounding can survive volatility. It cannot survive ruin. This distinction matters. Taking risks is necessary. Taking unmanaged risk is fatal. Market cycles expose behavioral weaknesses. Market cycles don't just test portfolios, they test people. Bull markets create overconfidence. Returns feel easy. Risk feels invisible. Leverage increases. Valuations are ignored. People assume recent performance will continue indefinitely. Bear markets create fear. Losses feel personal. Confidence evaporates. Long-term plans are abandoned. Assets are sold at the worst possible time. Both extremes are dangerous. In bull markets, people take on too much risk, setting themselves up for devastating drawdowns. In bear markets, they abandon compounding entirely, locking in losses and missing recoveries. The irony is brutal. Most people take the most risk when they should be cautious, and the least risk when opportunity is greatest. Compounding requires emotional discipline across entire cycles, not just during favorable conditions. Volatility is not the enemy, drawdowns are. Volatility is uncomfortable, but it's survivable. Drawdowns, especially deep ones, are far more dangerous. A 50% loss requires a 100% gain just to break even. Large drawdowns drastically slow compounding because they consume time, the one resource compounding cannot replace. This is why risk management matters more than return maximization. The goal is not to avoid losses entirely. That's impossible. The goal is to avoid losses so large that recovery becomes mathematically and psychologically improbable. Effective compounding is less about maximizing upside and more about minimizing irreversible damage. Risk versus return is not linear. One of the most misunderstood concepts in investing is that higher risk does not guarantee proportionally higher returns. Up to a point, taking more risk increases expected return. Beyond that point, risk becomes destructive. Leverage, concentration, and speculation can inflate returns in favorable conditions, but they dramatically increase the likelihood of catastrophic loss during downturns. The best compounders understand this trade-off. They don't aim for the highest possible returns. They aim for the highest sustainable returns. A slightly lower return achieved consistently over decades will outperform a higher return strategy that blows up once. Survivability beats brilliance. Time in the market versus timing the market. Time in the market beats timing the market is often repeated, but oversimplified. Staying invested over long periods is indeed critical for compounding. It's also true that attempting to perfectly time market tops and bottoms usually fails, but ignoring valuations, cycles, and risk entirely is equally dangerous. Balancing compounding with market cycles doesn't mean constant trading. It means acknowledging that risk is not static and adjusting behavior accordingly. Rebalancing during extreme conditions, avoiding excessive leverage, maintaining diversification, preserving liquidity, managing position sizing. These actions don't kill compounding, they protect it. The role of asset allocation. Asset allocation is the bridge between compounding and risk management. Different assets behave differently across market cycles. Equities offer high long-term returns but high volatility. Bonds reduce volatility but limit returns. Cash provides stability but erodes purchasing power. Alternative assets can diversify but introduce complexity. No single asset compounds optimally in all environments. A thoughtful allocation balances growth and stability, allowing compounding to continue continue even when parts of the market struggle. It smooths the ride, not by eliminating downturns, but by making them survivable. The right allocation is not the one that performs best in bull markets. It's the one that keeps you invested during bear markets. Sequence of returns risk. One of the most overlooked threats to compounding is sequence of returns risk, the order in which gains and losses occur. Two portfolios can have the same average return but produce vastly different outcomes depending on when losses happen. Early losses are far more damaging than later ones, especially when withdrawals or life events are involved. This is why aggressive risk-taking early can permanently derail compounding, even if long-term averages look attractive on paper. Managing risk early preserves optionality. It gives compounding time to work. Staying invested is the hard part. Compounding only works if you stay invested. Market cycles are designed to make that difficult. Corrections test patience. Crash test conviction. Long periods of stagnation test faith. Most people don't fail because their strategy was mathematically flawed. They fail because they couldn't stick with it through discomfort. The best compounding strategy is not the one with the highest projected return. It's the one you can emotionally tolerate across cycles. Behavioral sustainability matters more than theoretical optimization. Risk is personal, not universal. There is no universally correct level of risk. Risk tolerance depends on time horizon, income stability, liquidity needs, psychological resilience, life stage. A young investor with stable income can tolerate more volatility. Someone nearing retirement cannot. A strategy that compounds beautifully for one person may be disastrous for another. Balancing compounding with market cycles requires aligning risk with reality, not aspiration. Ignoring personal constraints in pursuit of higher returns often leads to panic-driven decisions that destroy compounding entirely. The compounding mindset across cycles. Successful long-term investors share a mindset, not a prediction model. They accept uncertainty. They respect risk. They plan for volatility. They avoid ruin. They don't try to win every year. They aim to stay in the game for decades. They understand that market cycles are not obstacles to compounding. They are the environment in which compounding operates. The goal is not to eliminate cycles. It's to survive them. Compounding is fragile to behavior, not math. Mathematically, compounding is powerful. Behaviorally, it's fragile. Poor risk management, emotional decisions, overconfidence during booms, panic during busts. These don't just reduce returns. They interrupt compounding altogether. Balancing compounding with market cycles means accepting a fundamental truth. You don't need to be right all the time. You just need to avoid being catastrophically wrong once. Compounding and market cycles are not opposing forces. They are intertwined. Compounding rewards time, consistency, and patience. Market cycles test those traits relentlessly. Risk is the price you pay for return. Risk management is what allows you to keep paying it. The investors, builders, and thinkers who succeed long-term are not the boldest or the fastest. They are the ones who balance ambition with restraint, growth with protection, optimism with realism. They understand that the true enemy of compounding isn't volatility, it's behavior that prevents you from staying invested. Survive the cycles, and compounding will do the rest. If this helped you think more clearly about risk, return, and long-term compounding, like this post, subscribe for more deep dives on investing, decision-making, and long-term thinking, and comment below. How do you personally balance risk and return across market cycles? Your answer might help someone else stay in the game long enough to let compounding work. The Rule of 72. How long does it take to double your money? Let's start with a simple question. How long does it take to double your money? Most people don't know, not because they aren't smart, but because no one ever explained it in a way that feels intuitive. They assume it's complicated. They assume it requires formulas. They assume it's something only financial experts can understand. But here's the truth. There's a simple mental shortcut that answers this question almost instantly. It's called the Rule of 72. Once you understand it, your perspective on money, debt, investing, and even career growth will change. What the Rule of 72 is. The Rule of 72 is a mental shortcut for estimating how long it takes for an investment to double at a given interest rate. Here's the formula. 72 annual percentage rate ducks approximate number of years to double. That's it. No calculators, no spreadsheets, no advanced math. For example, at 6% annual return, 72 6 Takluk, 12 years. At 8% annual return, 72 8 Clucks, 9 years. At 12% annual return, 72 12 6 years. It's simple, but the insight it gives is incredibly powerful. Why 72? You might wonder, why 72? Why not 70 or 75? The answer is practical. 72 is highly divisible. 2, 3, 4, 6, 8, 9, 12. That makes mental calculations easy. It closely approximates the true exponential growth formula for most realistic interest rates. Typically 5, 12%. The rule of 72 isn't perfect. It's approximate, but it's accurate enough to make fast, intuitive decisions. The real magic is that it turns percentages, which are abstract, into time, which your brain can grasp immediately. Simple examples that make compounding real. Let's see it in action. Suppose you invest $10,000 at 7% per year. 72, 7, 10.3. After 10 years, $20,000. After 20 years, $40,000. After 30 years, $80,000. After 40 years, $160,000. Notice what's happening here. The same return, applied consistently, grows exponentially over time. Now imagine you delayed investing by 10 years. That's one full doubling cycle missed. And the difference is enormous. This is the power of starting early. Time is literally more valuable than money. Compounding and the power of time. Most people obsess over return percentages. Very few focus on time. The rule of 72 makes this crystal clear. Even modest returns can create extraordinary growth if you start early and stay invested. Take 3% annual growth. 72, 3 cock 24 years to double. Take 6% annual growth. 72, 6 cock 12 years to double. Take 9% annual growth. 72, 9, 8 years to double. Small differences in return make massive differences in how long your money takes to grow. But the biggest factor is still time. Start early. Give compounding enough time. Patience is the secret. Using the rule of 72 beyond investments. The rule of 72 isn't just about stocks or bonds. It applies anywhere compounding happens, or its negative counterpart. Inflation. If inflation averages 3%, prices double roughly every 24 years. That means a $50,000 lifestyle today could cost $100,000 in your lifetime. Ignoring inflation is like ignoring a tax on your future purchasing power. It silently erodes wealth over time. Debt. Debt works in reverse. Consider a credit card charging 18% interest. 72, 18 clacks 4 years to double your balance. That's frighteningly fast. Compounding debt can turn a seemingly small loan into a financial nightmare. Fees. Even small fees on investments matter. Suppose your portfolio earns 8%, but fees reduce it to 6%. Doubling time goes from 9 years to 12 years. That's lost decades of potential growth, all because of small, invisible fees. Compounding skills, habits, and knowledge. Compounding isn't just for money. It applies to skills, habits, and knowledge. If your skills improve by 5% per year, you double your ability roughly every 14 years. If your network grows steadily, your opportunities double over the decades. Even health habits compound. Regular exercise, sleep, and nutrition pay off exponentially over time. This is why small, consistent improvements are more powerful than short bursts of brilliance. The neutrality of compounding. Compounding is neutral. It doesn't care whether it's helping or hurting you. Positive habits compound. Bad habits compound. Savings compound. Debt compounds. Understanding this is crucial. Compounding is only powerful if you direct it toward good things. The rule of 72 shows how quickly advantages or mistakes can multiply over time. The rule of 72 in career and personal growth. Let's apply it to your career. Suppose your skills improve by 5% per year. 72, 5, 14 years to double your skill level. Now imagine someone else improves 10% per year. 72, 10 talks 7.2 years to double. Small differences compound over time. That's why people who focus on continuous learning quietly pull ahead. Even soft skills, communication, leadership, emotional intelligence, compound if developed consistently. Behavioral lessons from the Rule of 72. The Rule of 72 also teaches psychology. 1 point: start early. Delay is expensive. Every doubling cycle you miss is gone forever. 2, to avoid high-interest debt. Debt compounds against you faster than most investments grow for you. 3 point: keep fees low. Small invisible drags destroy long-term growth. 4-point consistency matters more than intensity. Small, steady contributions beat large, sporadic ones. 5-point be patient. Most gains take time to show, but that's when compounding works its magic. It's a simple framework for long-term thinking in money and life. Limitations of the Rule of 72. The Rule of 72 is powerful, but it has limits. Assumes a steady rate of return. Does not account for taxes, inflation, or volatility. Less accurate for extremely low or high rates. Still, for intuition and mental math, it's unmatched. It's not about exact numbers. It's about understanding the forces shaping your future. Here are a few practical ways to use it. Invest consistently. Even small amounts grow surprisingly fast over time. Avoid unnecessary fees. They can slow down doubling significantly. Pay down high-interest debt first. Compounding works against debt too. Focus on skill development. Continuous learning doubles your value over decades. Start early. The earlier you start, the fewer extreme returns you need to succeed. When you make decisions with the Rule of 72 in mind, you start thinking in decades, not months. Why this rule changes mindsets. Most people fail financially not because they don't understand math, but because they don't understand time. The Rule of 72 makes the cost of delay visible. It makes patience feel powerful. It makes small percentages matter. Once you internalize it, impulsive decisions become harder to justify. You start thinking long-term. You start respecting the power of compounding in your daily choices. The Rule of 72 is simple, but it teaches a profound lesson. Small, consistent advantages, multiplied over time, lead to extraordinary outcomes. You don't need perfect strategies. You don't need genius-level insight. You need time, patience, and discipline. Understand how long it takes things to double, and you'll understand why patience is your most powerful financial tool. The earlier you start, the longer you let compounding work, the greater the reward. If this helped you see money and compounding differently, like this video, subscribe for more insights on investing, wealth, and long-term thinking, and comment below. At what rate is your money compounding right now? And how long until it doubles? Your answer might change how you approach every financial decision for the rest of your life.